Welcome to the Ellsworth Advisors monthly update for December 2024. I'm Kelly Keenan. This is Cameron Mealy, and today we will review the economic numbers of December, how our portfolios performed, and a little bit of highlight for the entire year, and then discuss what our thoughts are moving forward going into 2025. Cameron, why don't you kick us off?
Will do. Thank you, Kelly. Good morning, everybody. Happy New Year. Hope everybody's well out there. Let's review some of the standard numbers that we go through each month. We'll start with GDP, Gross Domestic Product. On December 19th, the Bureau of Economic Analysis reported that according to its third estimate, GDP in the third quarter increased at an annualized rate of 3.1%. This is a slight increase over the 2.8% that was recorded in the second estimate, which was published in November. And as you remember, in the second quarter, GDP increased at an annualized rate of 3%. So 3.1%, pretty strong GDP. Let's see if we can carry it through. According to the Atlanta Fed, we're not going to carry it through to the fourth quarter because the Atlanta Fed, as of January 3rd, is predicting that GDP will grow in the fourth quarter at an annualized rate of 2.4%. So still pretty strong number. We'll see about revisions, see what the actual number comes in at. But, pretty good number. Let's look at inflation, which has obviously been a hot topic that we've been talking about for a lot of these videos. We'll start with the Personal Consumption Expenditure Index. This is the Fed's leading gauge on inflation. On December 20th, the Bureau of Economic Analysis reported that the Personal Consumption Price Expenditure Index increased 0.1% in the month of November. For the 12 months ending September, the index is up 2.4%. This compares to 2.5% in July, 2.3% in August, 2.1% in September, and 2.3% in October. So a slight uptick, not quite at that 2% range that the Fed wants, but, trending in the right direction. On the Producer Price Index, on December 12th, the Bureau of Labor Statistics reported that the Producer Price Index increased 0.4% in November. On a year-over-year basis, the index is up 3%. So that is a little bit of a concerning number. That's the highest Producer Price Index we've seen in almost 4 years. And this result compares to 2.6% increase that we saw in October. So that's the one outlier right now that causes a little bit of concern. If we look at the Consumer Price Index, on December 11th, the Bureau of Labor Statistics reported that the Consumer Price Index increased 0.3% in November. This was after falling 0.2% in October. On a year-over-year basis, the index is up 2.7%. So major looks at inflation year-over-year, we're looking at 2.4% increase, 3% increase, 2.7% increase. Not where the Fed wants to be, but as I've said, certainly better than where we sat for a long time. Concerning jobs, this is according to Reuters. This is the December jobs report. Reuters is expecting, based on their survey of economists, they're expecting 150,000 new jobs added in December, with the unemployment rate holding steady at 4.2%. So we keep going back to this theme of GDP looks good, employment is sufficient for a growing economy. Interest rates, inflation still looks a little bit high, but certainly it has come down from where we're at. So let's kind of talk about 2025. A couple of themes that I am going to be following. Number one, inflation. Can the Fed slow the pace of inflation to get to that target 2%? Interest rates, the consensus on Wall Street is for 2 interest rate cuts in 2025, 25 basis points each, so 50 basis total. I have seen some reports that some economists are calling for maybe 4 interest rate cuts this year. I view that as highly unlikely. I think it would take a major disruption to see that kind of aggressive cut by the Fed.
A lot of it, that's, rate cuts right now are really hinging on inflation.
Yep.
And, we're kind of stuck. Path was nice going to 2%, but that kind of got stalled out about midway through the year. Now we're stuck. It depends which measure you want to look at. None of them are at 2. They're all a little bit closer to 3. And that's kind of where we're at right now. And when you look at the Fed funds rate at around 4.25%, inflation around 3, it's about a 1.25% spread there. Probably a little bit on the high side, get a couple cuts. Now you're about a 0.75% spread. Probably not a bad place to be. that gives the Fed some control.
And if
What would change it is if we hit a soft spot with GDP, which has been stronger than expected. And one of the drivers there, at least for the last several quarters, has been pretty substantial productivity gains in the U.S. economy, which, productivity gains have been meager at best for the last 10 years or so, maybe even 15 years. Now you're starting to see a ramp up in productivity, which many believe is kind of driving our GDP numbers. Is that a result of artificial intelligence? Possibly, or that's the theory, and that's great. That could get us right through, a rate hiking cycle. But that's kind of what we're facing, and inflation is going to drive a lot of what the Fed does with interest rates, and once again, that's going to be a reflection of what's going on with GDP. The kind of worst case scenario would be what's called stagflation, where you have low or no economic growth and inflation. We faced that back in the late 70s, early 80s. It's a tough situation to get out of, and part of what could potentially drive that is high debt loads by the government. So these are the things we're keeping a sharp lookout for. But the reality is there's also a lot of good things going on in the economy. It's very diverse. There's a lot of industries that are doing well. Productivity gains, beyond AI, could be a function of what happened in COVID. Companies that were a little bit weaker definitely got shook out in COVID. Government funds help companies modernize and maybe get on more sound footing, which has resulted in better productivity. So once again, there's not one factor that's driving everything because of the diversity of the economy. There's always going to be areas of strength, and we're kind of seeing that now. Right now, the stronger areas are outperforming are overwhelming the weaker areas. They are. And as long as we stay on that path, we'll be in pretty good shape.
Oh, and one thing we've seen in the Fed has preached over and over again is this Fed is not going to have a knee-jerk reaction to any sort of number. Good said, upside, downside. They want to be very methodical about this. They want to avoid some of the mistakes of past Feds where they jacked up rates quickly, then cut rates quickly. They want to be very measured in their approach. A couple other themes to think about. Obviously, we had a big election in November. There's going to be a change of administration in 14 days. The Trump tariffs. Now, are these a threat for better policy, or are we actually looking at trade wars? Trade wars could have big impacts on the economy. As we know, President Trump likes to use the bully puppet to, push his way. So is that a threat, or are we actually looking at tariffs on some of our trading partners? Again, Trump.
Well, tariffs too, theoretically, the concern with tariffs is they result in inflation.
Yep.
So that's a dynamic that probably is giving the Fed some pause, maybe unspoken, that, hey, well, let's see what happens before we start reducing rates, because that could be an inflationary driver. But the evidence on that in more modern times is a little less clear if they really do drive inflation. And part of it depends on who we're imposing the tariffs on, because certain countries will absorb those tariffs in different ways, and the status of those countries or where they're at in their economic cycles could determine how much of that's going to be passed on to the consumer.
So speaking of President Trump, obviously immigration policy is going to be a big factor. We're certainly going to see less immigration coming into the U.S. Is that going to hurt productivity? Again, could that lead to inflation? A lot of lower wage jobs are being filled right now by immigrants, and if you remove some of that population, does that hurt productivity? Does that lead to inflation? So there are, a couple of things on the Trump side that could lead to inflation, but then you also look at regulations. A reduction in regulations, unleashing American energy, all those things could be benefits for the economy. They could lead to lower overall prices for inputs. So there is a bit of a give and take there. Then we've got the global conflicts. We still have Russia and Ukraine. We still have the Middle East. How does that spill out into a larger situation in the Middle East? Do we find a peace resolution within Ukraine and Russia? Does NATO get dragged into this whole thing? I mean, the global conflicts are going to be something that, while there's more, not really risk to the U.S. economy, it's more headline risk. It can cause volatility. So certainly something to look at. Other thing that I'm going to be watching that I find fascinating is the Department of Government Efficiency. So can Elon Musk and Vivek Ramaswamy, can they really go in and cut $1 trillion of fat out of the U.S. budget? If they can, we could be looking at our first budget surplus since the Clinton administration. And imagine a situation where we could actually start paying down debt, have budget surpluses. I'm not sure it's going to happen because I think we know that President Trump is, like all presidents now, they spend.
Well,
They're going to spend money.
correct.
If you can cut out some fat, maybe they spend it a little bit more efficiently. Our government is certainly bloated.
Well, I think I don't see a lot of money being saved that will move the needle significantly. But I think what the Doge will do is force or cause some restructuring that will create more efficiencies. Maybe the government works better for us as people. Maybe services become better. I think that's really what happens, especially if they push through a lot of tech upgrades. I mean, we know that, large computer systems, which the government has, tend to be a little bit outdated. Can they be improved? Is there a focus on that? That would be a good thing.
I'm quite
It would
sure
probably cost some money, but in the long run, it'll be good.
our government is in the Stone Ages in terms of technology.
Yeah. So in the long run, it's gonna be good. Is it really going to save us money in the short term? Probably not. But the long run, I think, will be the right thing. In the long run, to address the deficit, it's really about growth, economic growth. That is the most painless way for the economy, the people in the economy, and for politicians to address debt. Maybe putting some limits on spending might be a good idea.
Grow
which
into your debt.
probably happen.
But
And
it-
inflation will bring it down. The big thing, there's always, we have uncertainty going into the year. And when we tie that back to the markets, especially you talk about the stock market, there are a lot of good things happening. All these different reforms that are going to be happening are, in the big picture for the U.S., improvements, making the U.S. a stronger place. And it's all going to be good. But in the short term, the market's kind of priced for perfection. So all these issues that Cameron mentioned, like you said, they're going to drive some headline news, which ultimately, when a market's priced for perfection, any kind of little bit of bad news is going to send ripples through the market, which, last year, I think we had 3 significant pullbacks of, 5 to 8% throughout the year. And yeah, we ended up marching forward again. But the reality is there's going to be more of those to come. And, we've dodged a 10% pullback for a couple of years now. So, they could become a little bit more extreme, a little bigger pullbacks. And I'll circle back that, yeah, these are short-term. These are probably going to be short-term pullbacks. The key is going to be able to, be patient and not make knee-jerk reactions with the portfolios based on one piece of bad news. So the outlook is good. I think the upwards trend of the market is still intact and will remain intact, but it's just going to be a bumpy ride, probably more so than, what we've been used to. Coming off, when we talk about returns, for the year, the S&P came in at 23%, 2 years of plus 20% returns. That's, that doesn't happen an awful lot. Has it happened, can it do 3 years of plus 20% returns? Yeah, we've seen it in the past. We've actually seen 4 years. Are we going to count on it? Absolutely not. NASDAQ had another good year, also up 29%. The Dow Jones, which isn't as heavily laden with technology stocks, only up 13% for the year. The Russell 2000, which measures small cap stocks, was up 10%. The MSCI, which EAFE, which is the international markets, only up 1.1%. I think that's reflecting, kind of a weak Europe. Japan's been all right, but, really it's reflecting a weak Europe, weak Canada. China's definitely been struggling. The emerging market index was up 5%, so a pretty good year for emerging markets. But still, you're looking at, other countries in the world are definitely more in, either approaching recession or maybe in recession right now. U.S. has been able to kind of remain above the fray. The question is, can we stay above that? For the month of December, as I mentioned, we had a couple pullbacks last year. Throughout the summer and into the fall, they were coming at the beginning of the month. And by the end of the month, things were back in the positive. The reality is last quarter, we had a nice little rally after the election. We had weakness going into the rally, little rally, or going into the election. After the election, we had a nice little rally. But once we got into later November and December, really we saw a market pullback in
We
December.
didn't see that Santa Claus rally we were all hoping for.
Well, no, we didn't. Dow Jones in December was down 5.3%. S&P 500 was down 2.5%. The NASDAQ, once again, driven by a handful of big tech stocks, actually eked out a gain of 0.5. The Russell 2000 small cap stocks, which were on fire going into, really into October, November. In December, Russell 2000 was down 8%. The EAFE, the international market, was down 2.3, emerging markets down 0.3. And we don't talk about it a lot, but, because it is the end of the year, the U.S. bond aggregate index, which basically measures performance of bonds, but more longer term bonds, that was actually down 1.6%. So, that's a reflection of longer term rates staying, especially the 10-year staying higher than expected. Today the 10 years clipping in at about 4.6%, which is definitely on the high end of what we've seen. Long term, is that probably in the right range? I would argue, anywhere between 4.5%, 5% is probably where the 10-year is going to be for a while. Our portfolios in December, growth with income portfolio, took a little hit. We were down 4% in December. Year to date, we ended up 11%. Big gainers in December. Toyota had a nice run, up 14%. Apple up 5.5%. Sony up 5.5%. Most everything else was down for the month. The biggest down stocks: Nucor down 24%, Lennar down 22%, Microchip Technologies down 16%, Iron Mountain down 14.5%. For the year, Nvidia is still the big winner in this portfolio, up 171%. Iron Mountain, even though we gave up 14% in December, for the year was up 55%, and Raytheon was up 41% for the year. The biggest laggards during the year: Microchip down 35%, Nucor down 32%, Nike down 29%. Dividend yield portfolio also down 5% for the month. For the whole year, we were up 9%. Big gainers: Darden Restaurants up 6%, Target up 2%. Laggards: Chevron was down 11%, Caterpillar down 11%, Blackstone down 10%. Gainers for the year: Packaging Corp. We ended up making about 42% on Packaging Corp. Blackstone, even though it was down 10% in December, was still up 35% for the year. And Caterpillar up 25% for the year, even though we gave up 11% in December. Laggards for the year: Dow was down 20%. That's Dow Chemical. And then, Duke was down, but we sold that, so I don't have a number for that. Price potential portfolio down 4% in December. Weak showing for price this year. For the year is down, or actually eked out a 0.5% gain for the year. We've done a lot of repositioning in this portfolio. I think we're pretty much in. I like the way it's positioned for this year. I think we're set up for some good takeout activity in there. December gainers: Google is up 12%, Amazon up 5.5%, Meta up 2%. So we added some tech to the portfolio. Laggards: Cigna down 18%, Air Products down 13%, Arch Capital down 8%. Gainers in December: Arch Capital was up 31% for the year. Markle Group was up 22% for the year. On the laggard side, we've pretty much cleaned out that portfolio from a laggard standpoint, did some loss selling in there. Big laggard for the year was Spartan Nash, down 17%, which we did sell in December. Appreciation with income portfolio, probably for the month, this was our best performer, only down 3.8%. For the year, up 17%. So a good strong year there. For the month, Broadcom was up 43%, Meta up 2%. Laggards: Cigna down 18%, Public Storage down 13%. For the year, Energy Transfer Partners, a big winner in there, up 54%. Equitable up 45%. General Digital up 22%. Laggards: Union Pacific down 5%, Cigna down 6%. When we talk about small caps, great year for the portfolio, even though we lost 7% in December. For the year, we were up 31%. Really no gainers in December. Everybody was down in December. We did take gains on IESC, which was up 151% since buying. But for the month, like I said, we got out of there early in the month, so who knows what it would have done during the month. Laggards, U.S. Wait a second here. So for the year, big gainers, U.S. Lime and Minerals up 89%, Graham Corp up 134%, Sterling Infrastructure up 92%, Northeast Bank up 66%. And, really from a laggard standpoint, once again in December, we kind of cleaned house with most of the laggards for the year. So that's kind of where we're at. Like I said, it was, expect some volatility this year. I like how we're positioned going into the year. We've kind of stayed on that quality side of the equation, which will help during the pullbacks, but we're not going to be immune to the pullbacks. The key is, because we're more fundamentally based and, most clients are holding fixed income or short-term T-bills in their portfolios, that'll help, kind of cushion the downside and also provide liquidity when we're in any kind of pullbacks that we may be experiencing.
Yeah, I think the important thing to remember is when you buy great companies that have a reason to be here, that are producing strong cash flow, growing cash flow, valuations will increase. They're going to be subject to headline risk. They're going to be subject to pullbacks in the market. But by and large, you buy quality, you hold on to quality, and it's going to pay off in the long run. So with that, we thank you very much for the trust you place in Ellsworth Advisors. If you have any questions, please feel free to reach out to us, and we'll talk to you in another month.
Happy New Year.
Happy New Year.